expected to see a pretty big gap up in early trade, and I think the setup as well is not looking too bad for the broader markets. This counter could be getting a bump up from the get-go, and that's what we are anticipating. 20%. That's far better than what the street was expecting. 20% gap up on MediAssist as it debuts on the exchanges today. So that's what we have in terms of listings. An exciting opening for this one. Well, we'll quickly detour from that and go across to Taher, Badshah, President and CIO of Invesco Mutual Fund, now joining in. Morning, Mr. Badshah. Thanks a ton for joining us.
Pleasure.
Early start of this year. Very quick couple of things, and I want you to put this in perspective for us. As we went into last year, it was very gloomy. The setup was concerning. China was a worry. US was headed for a recession, geopolitical stress. So the worries were extensive. The markets climbed over a wall of worries. At the start of 2024, we have a bit of a corollary now. So globally, the setup looks really good or bad, debatable, but things seem to be looking up for India. But we've already got a very sharp rally behind us. Do you think 2023 has already eaten into a large chunk of 24 gains?
I'd like to think that, while of course we're coming on the back of a very strong performance of 2023, and India, of course, as a market has significantly outperformed many of the global markets as well. But I think my base case view up until for the last recent time has been that, probably we are likely to see the continuation of this, at least in the first half of this calendar year. I expect much of the market gains in 2024 to actually come about in the first half of this calendar year, is when probably it will coincide with much of the expectations as far as, how the strong economic growth is concerned, especially the strength of the investment cycle and the way it is unfolding. It will also probably coincide with the market's expectations actually building regarding a possibility of inflation cooling off and interest rates actually coming off as well to some degree, or at least central banks start to more strongly indicate the possibility of interest rate cuts as we get into the first half of 24. And probably it will also coincide, of course, with election realities as they unfold in and around, let's say, May and June of 2024. So I think from an India standpoint, to my mind, it looks like much of the returns for 2024 will be front-ended. And then the second half is probably when I look to things cooling off. We are also at a stage where by which time in the next 6 months from now, we will probably get to valuations which will probably hit the upper end of the market spectrum. We are already at about 21.5, 22 times 1 year forward. Typically, India has seen it trade up to about 24, 25x on the upper side. So I think from now on until the next 3-4 months is when I expect valuations to actually get to that level. And then we actually start cooling off a little bit towards the second half of this calendar year.
So, Badshah, does that mean then the markets, in your opinion, for now are already pricing in earnings growth and potentially more rate cuts from the US Fed, and the disappointment on that front could lead to a little bit of a correction of sanity setting in?
I would say so, possibly. Yeah, I mean, there is a good amount of expectation which is built in. I would not deny that. Overall earnings momentum probably can be a little stronger. There are obviously certain pockets where we need to be a little watchful as well. But I think in general, especially those which are associated with the investment cycle, the industrial cycle, manufacturing, industrials, that part of the market, that part of the economy should continue to do well. We are looking forward to some of the other sectors perhaps becoming a little more stronger as we go along, especially the consumption parts of the economy, especially on the back of lower inflation and lower interest rates. So I think we're right up there. We could probably see some more acceleration, but by and large, I think there is a fair bit of enthusiasm and optimism built in as well.
So in that case, what do you think that could break the back of these markets in calendar year 2024? Valuations, you already talked about how they're on the higher side and may reach heightened levels in the next couple of weeks or months. But what do you think could break the bone? Or what could be that one trigger that could take us lower?
So at this stage, I would probably not be of the view that, we're looking at something which is a significant correction. I do expect that markets, once they probably, reach valuations which are at its peak, they start gradually winding down. It's difficult to, as of now, expect, or at least what is not visible on the horizon is something which can significantly break the back of the markets, so to speak. I think there needs to be a significant loss of enthusiasm as far as the earnings momentum for the economy is concerned, or for the growth of the economy to disappoint for that outcome to probably take place. So I wouldn't go to the extent of saying that we are going to get into a down cycle. We are still, from an overall economic standpoint, still in a reasonably decent place. But we have got to get watchful. I mean, we are now at a stage where 2023 we could probably look at markets playing the momentum and getting advantage of the earnings upside. But now I think we need to marry risks along with return. We need to probably be a lot more watchful of potential risks as we go forward. None that we can probably identify at this stage, which is likely to become very, very critical. But then there are a few things that we are watchful about. Let's say, for example, liquidity in the markets, liquidity in the system as such, not as much in the markets, but liquidity in the system. That, as you know, is constraining deposit growth in a way, and it's also probably kind of likely to kind of manifest in the form of slower credit growth as well, if at all nothing is done about it. So I think that is something that we need to be watchful about. We probably need to also worry a little bit about the lower end of the income pyramid. We need a little bit of support out of that for overall growth momentum to actually continue. We'll have to probably wait and see as to how the government positions itself from the point of view of the fiscal maths and the ability to support the investment cycle from here on as well. We've had 2 or 3 very solid years, and we could probably be in a stage where the growth can probably be a little lesser compared to what it has been in the last 2 years. So it can take away some of the sheen out of the industrial cycle. So these are the things that we need to be watchful about. It's not a time that we need to kind of it's not something which we have to be significantly afraid about, but these are clearly some things that we would like to watch during the course of 2024.
So, Badshah, I know as a mutual fund, there's only that much of a cash call that you can take. But if an investor had to ask you, of course, investing in a staggered manner is ideal, and that's the advice we'd give individuals. But what would you tell them at this stage? To take some profits off the table, maybe take a cash call and stay on the sidelines? I mean, how do you navigate this market for an investor who's walking into the markets today?
Well, the best way, I think, to do it is not as much to take a cash call. I would rather think that, there's always a possibility of markets going into a sector rotation phenomenon, and that happens all the time, and especially when we get to a stage when markets have done a fair bit in the prior 12 or 18 odd months. So I think it would be important to kind of diversify. It would be probably good to have a good mix of mutual fund schemes in your aggregate portfolio. Probably a combination of growth and value. That's something which would be important. We've also seen a very strong performance by the mid and small cap segments of the market. Would investors like to probably be a little more tuned towards flexi cap kind of strategies, which give them a little more balance and probably gives them a little bit of support in terms of overall valuations as well. So I think these are the things that you can probably do. Cash calls are typically, to my mind, and we never advocate those, not from the point of view of anything else, but it's always difficult to time the markets, and especially if you can probably take a somewhat longer term call, at least 3 or 5 years is what you have in mind. Then I don't really think you need to necessarily take cash calls, and especially if you can probably manage volatility to the extent of 5 to 7% in the market, which can probably come about at any point in time. I think you should be good with that kind of an asset allocation. So that's what I would probably recommend to investors at this stage. So
no cash calls, stagger your investments. That's the word coming in. Mr. Badshah, I want to talk to you about banks. What is the sort of view you have on banks? Are you overweight, underweight at this stage? It's been more or less a big mixed bag. The reaction to HDFC Bank was for everyone to see. Numbers maybe were viewed disappointed. The street was disappointed. The stock has corrected. On the contrary, ICICI Bank, Kotak have actually managed to please the street, and the stocks are trading firm. How do you feel about banks as a pack? Do you think they could be the leaders as we go into this year?
So, we've started off the year giving a reasonably strong call about financial services, banking and financial services being the place where we probably find value. A couple of reasons. One is that the whole the banking space, of course, has underperformed in the last 2-3 years, and especially the bank index itself has underperformed the Nifty by a fair bit over the last 2-3 years. So, one, from a relative valuation standpoint, we feel that this is a reasonably decent opportunity. We also have, we believe that, as of now, we would like to believe that if the overall economic cycle were to stay reasonably stronger, then we still get a year or two of decent credit growth. Although I would like to qualify this by saying that there are some of these hiccups that we've noticed, and I mentioned about that with regard to the liquidity in the system, and that's kind of constraining deposit growth, and probably it can have repercussions on credit growth in the system as well. But my sense is that probably the central banks would, in conjunction with the finance ministry, especially post-budget, look at some of those liquidity-related constraints which are there in the market to make sure that the credit cycle remains where it is. So I think we would like to think that the credit cycle is supportive, and some of these banks can still compound book values anywhere between 13% to 15%, and they are reasonably priced for that outcome, at least compared to the rest of the market, many other pockets of the market. So I think there is a space that we like. Along with banking, I would say that the entire financial services place is also kind of looking up very, developing very well.
So break that down for us. Right? Yeah. You've got your large cap private sector leaders. You've got a bunch of broader market PSUs that look very attractive at this stage. You also have non-lending entities. Yeah. So anybody in the capital market play, for that instance, or an NBFC. What is your pick from across these verticals, and where does your bias really sit?
Sure, great that you brought this up. And so we run a banking and financial services fund for a good number of years, and it's almost a 15-year kind of track record. Yeah. And, what we've been now positioning ourselves for is a much better balance between banking and financial services at an aggregate level. I think 5 years ago, we were probably having this fund position for about 80-85% exposure to lenders, combination of banks as well as non-bank NBFCs. Today, we have a situation where we are more like 50-50. So the lenders constitute about 50% of the portfolio, and nearly the balance 50% is in financial services.
So financial services being a BSC,
non-lenders, you're talking about exchanges, you're talking about
CAMs, maybe
you're talking about capital market intermediaries, you're talking about insurance, you're talking about wealth managers.
Now, this space has already seen a sharp run-up in 23.
It has, yes.
But there is still some room
What we would like to think is that these are more secular growth stories. This is something which we would like to think is relatively less cyclical. So in a banking and financial services fund, we are now providing a good combination of cyclicals versus non-cyclicals, a combination of growth versus value, a combination of defensive versus aggressive. So I think that's a better mix compared to what it used to be in the past, and that's just because of the way opportunities have emerged over the last some time because of the financial inclusion and everything else that has happened on the financial stack.
Exactly. Savings,
So my sense is that, and within banks itself, I mean, since you brought this up, we would like to think that at this stage, we prefer private banks to some of the public sector banks.
And these would be the large cap private banks?
A combination of those, but by and large, yes, predominantly large cap banks.
Would you be able to comment on HDFC Bank?
I'm
looking for your portfolio, your underlying portfolio.
So it's there. So in our portfolios, of course, we have a good positioning, and we would like for us, it is a value proposition at this stage.
So you would have added, or the team would have added after the recent fall.
At least in the value strategies, which because it is a value proposition for ourselves, and that is how we categorize this name in our scheme of things. I think it makes sense to have it, or at least have it adequately represented in some of our value strategies, and therefore you will see it being up there in a few of those portfolios which follow that strategy.
Talking about value, a couple of sectors where I feel like we've missed the value is railways, defense, or anything government-centric. The rally is there for anyone to see. I mean, an IRFC was checking it this morning. 6-month returns 400%, 1-month returns 100%. I mean, these numbers are unheard of in other times. Order wins are big, and that's the big story. And similar in terms of renewable energy this morning. The Prime Minister tweets and the stocks rage in trade. Execution is for all of us to see whether or not it's going to come through. Are you still very optimistic on some of these government-centric sectors or plays? If there was a new investor coming in who had no history of what has happened in the last 1 year, would you advise them to buy these stocks, despite what we've seen in terms of stock movements?
So again, here too, we have been running a PSU strategy as well. We are one of the very few in the market which actually runs a PSU fund, and we've got this fund running now for the last, again, more than a decade. Up until the last couple of years ago, I think this fund was obviously, for us, it was always a value positioning. We all know that PSUs were not only trading at a discount to the market, but they were also trading at a discount to their own history. And to that extent, it's not surprising that at one level this value has unlocked. It always does significantly, and it always does when the right elements, the right ingredients actually fall into place, and that's what has happened. We all know that many of these PSUs are actually the largest beneficiaries of a good economic upcycle, and especially if government spending is supportive. And many of these businesses actually dominate some of those industries, right? So it's not surprising, and some part of what you said is also a bull market phenomenon which unfolds, and then you get those very...
But is all this already in the price, Taher? So that's where I don't understand a lot of this.
So now what we are saying is that we are no longer looking at this sector or this space from a value standpoint. We now have to assess it in relative to their
growth potential.
Impending growth, exactly. So you mentioned about order books. Order books are obviously comfortable. There will be places where even order books and probably potential earnings growth over the next 2-3 years is likely discounted. So we have to now be careful. I mean, this is not a space where we can probably just close our eyes and, they are now at a stage where they probably are evaluated in the same way as what, let's say, the private sector companies are in several businesses.
I mean, I did read on Friday, was it, that IRFC market cap crosses 2 lakh crores?
Yes.
So,
I mean, like I said, I mean, the only thing that we can do is that we now have to, compare these with their private sector counterparts and see if they're still making sense from a growth standpoint. But obviously, these are not, at least we would not prescribe this fund to our investors from a value perspective anymore, which it has been for a very long period of time.
So you're not recommending the PSU fund to your investors?
We are at least not telling them this, that look, buy this fund from a value standpoint. This is now as good a growth story, and you have to evaluate this growth proposition versus any other growth proposition.
And the returns of this fund must have been phenomenal for you in calendar 2023.
Absolutely, it's mind-boggling, to say the least. So obviously beyond expectations, but this is a culmination of a lot of underperformance of the last 5 years as well, last a good number of years over the last decade. So I think that's how the market typically tends to behave. And like as I said, I mean, you need all those elements to fall into place, and then you get a Lollapalooza effect, as they say, in those places. And that's what has probably happened here.
Wow, that is the PSU space. Invesco has a PSU fund that has been an outperformer, but like Mr. Badshah said, of course, finding value in this space is now becoming a little bit of a challenge. We'll take a break. We'll come back and continue our conversation, so stay tuned. Welcome back. We are in an exclusive conversation with Taher Badshah of Invesco. Taher, we've talked about banks, we've talked about PSUs. Another space that comes to mind is real estate. 80-odd% rally last year. But what's worth the mention is, historically at least, what we've seen is real estate is usually the last leg of any bull run. You know, when investors start buying real estate instead of equity, we know there's things to be concerned about. How do you feel about the real estate sector? Do you think we're at the start of a rally for the space? And also, if not realty alone, the real estate ancillary, how is that play looking to you at this stage?
So, I mean, you're right in one way that we've seen, at least maybe on one occasion, if not more, that real estate typically tends to kind of define the peak of the market as well. But I think we're seeing some differences in the past real estate cycle versus this, and we'll probably keep monitoring as to how this unfolds, especially from the point of view of the nature of the demand and the drivers of the demand. I think we're dealing with an industry which is a lot more formal, regulated compared to what it used to be, let's say, in the past cycle, and therefore the probability of it benefiting some of the more organized players should perhaps continue compared to the past. The second is that we're seeing, while we're seeing a frenzy of demand, but we're also seeing a fair bit of that being more user-driven demand rather than it being investment-led demand this time around. So that probably makes it a little more different. Third is affordability levels are much better than what they used to be at the same time of this cycle in the last one. And I'm going back all the way to 2008, 9, 10. That is the time when we actually saw the cycle peak, and the drivers were pretty different at that point in time. I would also, but I at the same time, I would like to think that given the performance of many of these stocks in this place, we're definitely not early cycle. We are somewhere mid-cycle, if not the top of the cycle. And I would like to think that yes, I mean there still has a fair bit of room. The space still has a fair bit of room, of course, with the usual caveats that we have to avoid some of the pitfalls here, and try and be with companies which make sense. So that goes without saying. But I would like to think that we are probably more mid-cycle than top of the cycle at this stage.
Right. You've talked about a few sectors you like, and we also talked about how it's all about sector rotation. Last year belonged to defense, railways, PSU. What are your top sector bets this year, A? And I'm going to try and slip another quick question along with this one, is how do you feel about the chemical sector? Do you think they could reclaim their lost glory after a long hiatus in the next few quarters? So chemicals and the other sector bets for this year.
So that's a nice one. So, we are in that space where we ourselves are kind of debating in our minds as to how we should position ourselves for much of 2024 and maybe a little beyond 2024 as well. And like as I said, we have to be a little clear about how strong will be the investment cycle in India, especially after the last 2 years of very strong outcomes. Part of it will probably be dictated by the budgetary positioning that the government takes, and we'll take it from there. But be that as it may, I think we believe that some parts of consumption, like as I said earlier in my conversation, is something that we are looking at quite keenly. We think that those are parts which have underperformed the market, and there's a good possibility that just by the virtue of rotation, some of these may come back. Maybe they might be supported by possible cooling off of inflation and the expected decline in interest rates as well in 2024. So I would like to think that we might have a relatively better balanced economic outcome, not only driven by the investment cycle as it has been in the last 18 to 24 odd months. Could be a combination of investment as well as consumption coming back, and that should spur some of those.
Rural versus urban?
It's not as much, incrementally now in India.
Luxury, I should say.
It's more high income versus low income. It's more about income levels rather than geography. So I wouldn't. We are incrementally not cutting the market based on where you live or rural versus urban.
So lower mid income or higher income?
So mid to higher income, and of course the ultra rich has actually done exceedingly well in the last some time. We would like to think that the low to mid income, which has been a struggle over the last 2-3 years, potentially can come back, and we should be able to identify some plays that belong to that. I would also like to think that somewhere in the course of 2024, we might be up with the proposition that could we have global versus domestic,
Local. And pharma could be one theme there,
so
right?
some of the global, sectors or globally exposed sectors, pharma is one that you called out. You could probably also see tech becoming a little more, certain from the point of view of demand. As of now, the sector has done well, stocks have done well, but they've not done well as much on the merit of the business. But if the business starts strengthening in the second half of the year and into 2025, then that is a story which can still have legs. Pharmaceuticals is what we talked about. I would like to think that if we extend global plays, then even commodities, and that is where your question on chemical commodities, chemicals as a commodity as well. I think that's something which, again, from a value standpoint, we would like to look at it. See, it's 21, they were value, they turned into growth, then 22 again, 22 and much of 2023, actually, they turned into a negative cycle. So I think we are now starting to look at them more from a value standpoint because that is where pockets of value actually are. So I think the whole commodity space, including chemical commodities, from a value standpoint, particularly for our value strategy, does make sense. So we are being picky out there. We are trying to see what we can do.
But it's hard finding value at this stage across market caps.
It's not easy, yes, I would say so. But, I've also noticed that in the last decade or so, by rotation, because of rotation and because of excess concentration or extreme confidence of the market and a few pockets of the market.
There's always value
There's
somewhere
always
else
the other side of the
sectors.
market which gets ignored and converts into value, right? So I think we just need to be kind of, watchful, and we should be on the ball and try and see as to which is a place where investors are completely ignoring the outcomes for now, and that typically becomes a good starting point.
So cautiously optimistic is probably the best way to sum up how you feel about these markets.
Overall, yeah, I think I'm reasonably fine, but like I would say, 23, I did not worry as much about,
valuations,
negatives.
Because all of that was already
much of it was, the picture was very clear, but then when the picture becomes very clear is when you have to be actually a little more watchful because you don't know what will hit you. So I think 24, I would say, good from a return perspective, but please don't lose sight of your risk.
Right. Well, thank you, Mr. Badshah. Great talking to you today on the show. With that, we're completely out of time. Thanks for watching Talking Point.